All right, good evening, everybody. Thanks for coming out tonight. The goal of Linden Leap was to bring the industry together of the bankers and brokers and lenders to connect, build relationships, network, and then just discuss the challenges and the opportunities that we're seeing out there in the market. We believe that much of our success, whether it's in life or in business, has come from having these strong, trusting relationships. So that was the focus tonight, was just to get together and connect and continue to harvest those wonderful relationships together. My name is Steve Corliss. I'm a managing partner at 1892 Capital Partners. We're a fifth-generation family-owned company. We're primarily focused on real estate development, real estate investing, but we spun up 1892 Capital Partners a few years ago on this idea that we could leverage our experience and knowledge to help other developers and builders and investors finance their next real estate project. So we've been developing real estate here in Washington for well over 50 years. We understand the challenges that come along with projects, and you combine that with our ability to be very flexible and creative with our loan underwriting and our loan terms, because we're a boutique balance sheet lender. We can be very creative in how we underwrite. It's carved out a very nice niche for us, and it's been an absolute blast getting involved in this industry. And again, it all boils down to connections and relationships. Our fund director, Charlie Farnsworth, the family's known Charlie for a very long time. It's a relationship we built for, I think, 15 plus years. And so when we were ready to dip our toe in the water of, the lending world, we knew Charlie was our guy, and we really wanted him to come work with us. So again, it's about relationships, about connecting with people and building out that network. So that was our goal tonight. But we also have some great speakers here that I'm really excited to hear from. Just before I get started, introduce the next speaker, I do want to give a quick shout out to Sid Hatch. I don't know where Sid's pulling down the blinds right now, but Sid is our marketing manager. She's the one that's posting a lot of our stuff on LinkedIn, if you guys have caught it. She organized this entire event tonight, and we wouldn't be here if it wasn't for her. So she's a wonderful she's a master at what she does. And again, thank you, Sid, for all that you've done for us. And then a quick shout out to Stewart Title. They're a great business partner of ours. Wonderful individuals are here tonight to speak, so thank you to Stewart Title and all that they've done for us. So our next guest speaker is Warren Samick. Warren is Senior VP National Capital Markets at Stewart Title. He's a brilliant guy, really fun to talk to. I had lunch with him last summer and just kind of walked away. My mind was blown by how knowledgeable he is, and incredibly engaging and super down to earth and fun to talk to. So I'm looking forward to Warren's presentation here. Warren, come on up.
Thank you to 1892 Capital. It was an honor to be invited to be part of this event. They are such a cool company. For those of you who don't know 1892, their approach to deploying capital is unique. Their history is proven, and this team is so smart and authentic. That's hard to find these days, a smart, authentic team in this business. And one thing I love about them is they are all about relationships, and what we're going to find out more and more is we are in a time of uncertainty now. We all know that. I'm saying something pretty obvious. But there's strategic keys to navigating this market, tactical keys that will allow us to navigate and thrive. And we're going to talk about that in a couple of minutes, but one of them is our ecosystems. And we've always managed our relationships, but the way 1892 Capital focuses on the value of relationships, it's important now more than ever to do that. So we're going to look at a couple of things that's hitting our market now and why relationships matter. We'll kind of thread that theme in. My name is Warren Samick. I'm Senior Vice President of Stewart Title National Commercial Services. So I manage the Northwest, Portland, Seattle, Tacoma. I also manage the capital markets, Chicago, New York, and LA. But I'm going to be managing Dallas soon. Does anybody know why? Because the Texas Stock Exchange starts trading January 2026. And we're going to have a theme here in my presentation about shifts. Things are shifting. I have friends of mine that ask me all the time, Samick, how are we going to bounce back? When are we going to bounce back? We're not going to bounce back. What are we going to do? We're going to bounce forward. things are shifting. We're going to get ahead of this. We're going to plot an intercept vector to make sure we know where the market's headed, because if people are waiting around to get back to where we were a few years ago, you're going to be waiting a long, long time, right? So we're going to talk about the shifts in the market. Shifting from the East Coast, the New York Stock Exchange, to the Texas Stock Exchange is going to be a thing. There's already 4 large REITs that have already pre-listed on it. And the waiting period to get on the Texas Stock Exchange is now longer and longer and longer. So it's kind of part of the shift. So with me today from Stewart Title is Rob Hurricane Haney, the Associate Senior Underwriter, also the South Sound Manager. And I also have Jackie Lindstrom, Business Development Officer for Stewart Title National Commercial Services. These two are hyper talented. So if you get a chance to say hi to them later and talk to them, they are great at what they do. So I'm going to dive in. So I'm going to give you a couple of things here right off the bat. So October 19th, 1987. See, I start aging myself because this is brutal. Because you know the power is going to the youth now, right? We have a demographic shift. Taylor Odegaard and I were just talking about this. Things are shifting to age group that's outside of me. But I started my first day as a stockbroker for a company none of you have heard of before, Shearson Lehman. It was a power hitter. So I started on October 19th, 1987. Does anybody know what that is by any chance? Probably not. It's all good. Yeah, nice. Black Monday. My first day as a registered representative, Series 7 and Series 24. It's like, welcome to Earth, kid. 22.6% drop. Started my financial career. Mid-career, fast forward, I come back from an overseas deployment to Afghanistan and Iraq. The date I returned was September 18th, 2009. So when I left, the market was top, kind of frothy. There's some cracks in it. It was starting to give a little bit, but it was at the top when I left to go. When I came back, I felt like Charlton Heston at the end of Planet of the Apes. There's a scene, this movie, it's a famous movie, The Planet of the Apes. The guy's walking on the beach, he's wondering what planet he's on. And then all of a sudden he bumps into the Statue of Liberty as a torch hanging out of the sand. That's how I felt when I came back. All my friends were laid off. The market was no longer topping. The Dow I thought was a misprint when I was reading it. So adversity, resilience, we're kind of going through that a little bit now. Some of us in this room have been through the GFC, then the fallout of the GFC, then COVID, then the new interest rate environment because the inflationary pressures of COVID stimulus. Then we think we're getting a handle on the cycle. We think we're getting a handle on this new interest rate environment. We're going to have a return to mean. We're not going back to zero interest rate policy, you all know that. But we're getting a handle on things, and then what happens? Well, we got tariffs. And so you can make money, as you know, going up. You can make money going down. You can even make money going in a sideways market. You could write options. You could write call contracts. You could make money sideways. But you know where you can't make money? Is when you don't know where the market's going to go. Because now you're making a blind bet. So what do we have here with the tariffs? We have some adversity, right? So we're going to get through this just like we got through the GFC, just like we got through COVID. But the theme of this presentation is going to be shifts. Shifts in the market and how we're going to get ahead of it. And so what's shifting right now? The capital stack's shifting. In Seattle, because I was charged with doing a Seattle-based presentation, but it also mirrors some of the nation, capital stack's shifting. Who's making loans for what asset class is shifting. And we're going to talk about the shift. Technology is shifting. Technology has reached an inflection point. We actually have a local visionary of a great data innovation company, Taylor Odegaard, who I'll introduce later to come up and talk about what's happening. But technology is reached an inflection point where it's going to start affecting two things: how commercial real estate is done and the labor market that supports the entire nation's economy. So we'll talk about that. Third thing that's shifting is government policy. We have a government that is trying to create a new world order. And it's not my place to comment on whether the new world order is good or bad. My place to comment as a data scientist and a finance guy is how is this going to impact our investors, our customers, our insured. And I will tell you that there is a furry, feathery black swan waiting in the corner. For those of you who know what a black swan is, if this administration does not get the policy right. So if we get the tariffs wrong, if we get trade wars wrong, maybe it's going to be a small black swan, or maybe it's going to be a big black swan. But we got to get ahead of it. We got to kind of know. We got to know. You know, do we feel comfortable with what's going on, and how are investors going to make decisions? So here is, so we're going to cover, this is what I have in store for you real quick. We're going to cover Seattle's asset performance for Q1. We're going to cover the capital markets and what's happening with them. We'll talk about distressed assets, kind of a mystery, right? Those of you who've been in this thing, where are the distressed assets? Do you guys have them? No, nobody's got them. So we're going to talk about that. Hurricane Haney's going to come up here and talk about the distressed market and receiverships, because we want to talk about opportunities too. There are opportunities to be had in every inflection point in a market, right? Rob's going to talk about that. And then we're going to bring up one of the great innovators locally of CRE Data Innovation, the CEO and founder of Navigator CRE. So for those of you who know Palantir, it makes it easy for me just to say Taylor's companies like the Palantir of commercial real estate, because they are. So data, AI, innovation in data analytics, he'll talk to you about that. So that's what we have in store for you. So let's dive in. So Seattle, Q1, $2.65 billion, 123% year over year. We beat the whole rest of the nation. We're the #1 MSA in the nation. But we have to unpack that a little bit, right? Because this $2.65 billion, 950 million of it was one retail deal. One retail portfolio. So it really puts us back to 1.6 billion, which is about nominal to profile. It's about what we did last year. If we take out that almost $1 billion real estate deal. 161 properties traded, 158 were refis. So 161 sales. That's a little bit low, right? So normally we're at about 65% refi, so we're about 50-50 there, but that's us. 1.2 billion local. So local investors did 1.2 billion in transactions. National did 1.4. So you take that $1 billion out, we're getting close to normal. So this is kind of where we're at for the buyer composition. Everything's fairly to trend line except for that blue. It's institutional, and that is that big retail purchase. So that big retail purchase, Sid, thank you so much for making this slide. You should have seen this nightmare of a slide I sent to her. Now it's readable. It used to be like this jumble. But so this is what went on by asset class and buyer type, year over year, quarter over quarter. Multifamily, no surprises, right? It's 577 million, up 121%. That's our strongest asset class in Seattle. Office is not a surprise at 190 million, down 45% quarter over quarter. But look at that gray bar. Look at who is doing office. That's not a surprise, right? It's owner user. The gray bar is owner user. There's not a lot of REITs interested in this. Cross-border picked up, which is surprising. Mostly Canadian and South Korea picked up the cross-border office stuff, but most of it was owner user. Multifamily is not a surprise. Private went back up to being 83% of the capital stack. So this is how much of the entire purchase was made up by buyer classes, right? So multifamily, you've got the private buyers, office, you got owner users. Industrial is not much of a surprise, although the institutional people kind of downshifted in industrial. $450 million, though, it's 80% quarter over quarter. Industrial multifamily still doing strong. Bright green right there, right? Retail. Retail is up to 1.2 billion because of one portfolio. ROIC is a publicly held REIT. Blackstone, I think the fund, I'm trying to recall the fund's name, Retail Privatization Fund 2025. So they bought 101 retail assets, 22 of them in Washington, $950 million, core consumer essential retail. That's what the prospectus of the fund said. So $950 million in March, closed in March, 22 properties, and this kind of skewed our numbers here, right? Because you take that billion out and all of a sudden retail is down around a couple $100 million bucks, which is nominal profile for last year. But that's why that big investor institutional chart's so big for retail. And the hospitality is kind of flatlined a bit, 58 million. But that's basically the composition of who bought what for the first quarter. Seattle's still one of the stronger markets. Even if you took that retail out, we're still one of the stronger MSAs. New construction, $2 billion in Q1. And we're going to top off 6.9 billion this year. That's some serious inventory coming in. So 6.9 billion topping off, 2 billion constructed. You can see the split's about half and half, right? Half is multifamily, that's the same as market share. Half is industrial. One Lennar mixed use. Anybody know the Cortera project at all? in here. $350 million mixed use. That was kind of the big dog on the $2 billion in construction starts. Construction starts 15% year over year. So that's good for Seattle. So, and the 6.9 completions is also high. So where's the lender mix going? This is where the lenders are projected to go. So Seattle's Q1 right now is projected to be about $15 billion in 2025. Last year it's in the $10 to $12 billion, but the projections are all pre-tariff. So all this data came in pre what we're going to do with tariffs. So now we used to run these charts. So I sit on the advisory board for the largest large language model commercial real estate company. The most compute power, the most tokens, the most parameters. It's the largest one called OpenCRE AI. So we run an amazing amount of data sets at this. It's in partnership with Stewart. And right now I can tell you the tariffs have thrown things off. And I know the president has walked back the tariffs apparently, right? So that's good news. But if you look at the stochastic predictive models that we used to run like even 4 weeks ago, we have a consensus band. So you'd have a chart, and then you have something that looks like a river with the upper bound and bottom bound of the data. And so it would tell you where the yields were going, interest rates, everything, supply, demand, liquidity. And it would just look like a river on a chart. And you'd be like, this upper bound, the lower bound, these are all the top people, Goldman, Apollo, everybody, thousands of banks. Now when you run the chart, because I just ran it 3 days ago for Charlie and Steve, it looks like a kid spilled a bowl of Skittles on the ground. Looks like a scatter shot. There is nobody that has alignment and sentiment. There is no consensus band in any stochastic model, means we don't know. So if somebody tells you they know what interest rates are going to do, or what the cap rates are going to be, or all this stuff, they're just either trying to entertain you or entertain themselves. Because I'm telling you now, all the top minds plus the top AI model in the world for commercial real estate does not know. That's what it looks like Skittles. When it returns Skittles and not a consensus band, that means nobody knows anything. So this 15, and why did I tell you all that? Because it's $15 billion. $15 billion is projected in 2025. We're going to start getting back to 2017, 2018 rates for lending, but don't take my word for it. So this is where the capital shift's happening. So banks used to be what? 45, 55% of the capital stack, yeah? So now what are they? What's the banks at now? 30%. So somebody's made up this money for the capital stack, right? So who's made it up? CMBS and investor driven. CMBS is going from 3 to 12%. This year, CMBS is projected to be 18%. That projection, I believe, because these are people that are actually filling out, this is where we're going with our pipeline. So investor-driven, life companies still looking for multifamily office, not so much anymore. They did last year, not this year. They're looking for multifamily, some industrial, but they're going to carry some of the heavy lifting, and they're going to go from 17 to 22. But look at that CMBS. Private CMBS is exploding right now. So it's just a capital dynamic to get ahead of. Construction financing, so what's happening? Banks, you can clearly see going down. Who's leading the charge? You're going from 20 to 30%. This year is projected that investor-led financing going to be 38 to 40% of the construction market. So for those of you who do construction, this is a dynamic that's happening right now in the pipeline. You can't have a commercial real estate presentation without putting up the debt wall and debt maturity slides. That's not legal. It's not even right. People think you don't know what you're doing if you don't at least put up the debt wall. So there it is, $12 billion maturing debt in 2025. But that's not the fascinating slide. That's not the fascinating stat. This is the fascinating stat. It's my favorite. I do these presentations all the time, and this is what I talk about is this gray bar. So nationally, $625 billion is maturing in 2025. You can see the bands there. Who's maturing, where their debt. Looks like CMBS has a lion's share of the stack. You can see it in the color code. But really all you got to worry about is 625. So out of 625, we have a backlog on that gray box. What's that gray box? It's about $515 billion. I don't know what. That means the gray box means that loan is done. It's done. It's already matured out. But it hasn't traded and it hasn't refied because I already have the data. I've got not only RCA and MSCI, I have OpenSeries AI you cannot hide from. It extracts all data from everywhere. That's it, $515 billion sitting there. So what are that? Maybe it's triggered extensions that haven't made our reports yet. So you've got some triggered extensions. There's some money people here, that know what I'm talking about. Also, you have negotiated extensions. We deal, as a title company, we deal with law firms a lot. And they are busy. They're busy doing loan mods. Right, Rob? They're busy. So you have negotiated extensions, you have triggered extensions, something Rob's going to talk about. You have things that are in pre-receivership. Really things, mostly assets should look at going into receivership before foreclosure. I can let Rob talk about why, but receivership is a growing pipeline for everybody. It's a way to capture value. It's a way to get the asset healthier and out on the market in a better framework. It's better for the market. But some of this gray is going into receivership. Some of it is triggered extensions. Some of it is negotiated extensions. But this gray bar, I've done 3 presentations in a row. 3 months ago, it was $300 billion. 2 months ago, it was $400 billion. This presentation for Steve and Charlie, we ran this thing. That's the number. I'm not the smartest guy in the room by far, but I can connect the dots. So the next time I do this presentation, we're going to be up in the mid-5s, 6s, and mid-6s. This overhang has to go someplace. So it's just something to watch out for. There could be opportunities there. There could be some light calamity. Seattle's $5.4 billion of that number. So $5.4 billion gray box in Seattle right now. So for some of you, that's opportunity. Some of you, that gray bar is opportunity, right? So this is one of my favorite slides. I don't know why. I really don't, but it is one of my favorite slides. It's what I call the Wonder Water slide. So this slide depicts the assets that are under water. Asset value lower than loan. So 30% of office is underwater. I call it Wonder Water because they're underwater and I'm wondering what they're going to do. Because I know the capital market out there and I'm like, nope, that's probably not going to happen. That's not going to happen. So in Seattle, the office Wonder Water stock is at 42% right now. So 42% of office is underneath its loan. So one point of fact, if any of you want the table data, like the actual granular data that the AI company that Stewart has partnered with to generate that, you can have the table. Just email me. We'll send you the actual table data. There's also a couple of white papers that some of you may be interested in. If you email me, I'll send you the white paper. But I don't want to spam any of you, and I don't know some of you, so I'm not going to bug you. But if you want, you can email me. Just come up, get my card later, and I'll give you my card. How are we doing for time? Okay. Well, this is kind of my last one, so I'll make it quick. So we got headwinds and we got tailwinds. So this is a very in-depth, very powerful dive by the AI engine to look at Seattle. And this is not the only place we're presenting this, so there are some other places that have weighed in and kind of verified this. So it's tailwinds and headwinds. So I'm going to make it quick because we have other speakers that come up and they've got great things to talk about. Let's talk about the tailwinds. What's the wind at our back? Our chief economist, Dr. Ted Jones, taught me 2 things about real estate. 2 things, and it's always been right, and he was brilliant. One is there's no such thing as a national real estate market. But a lot of you know that. You've been in real estate, you know that. The other thing he taught me, which, I have an econ and tech and finance background. I kind of thought I knew it, but he really drew it home. He says it's jobs, jobs, and jobs. It's everything. Everything in the engine. We'll get back to that. So we're going to talk about that today, right now. Seattle's tailwind is actually in employment. So we're at 0.9% growth. The national growth rate is 0.5%. We are growing AI jobs here, and AI is about ready to displace other MSAs that are not AI heavy. And again, I'll send you the table data, but look at this. So 0.29 or 0.9% growth versus 0.5, driven by cloud, cyber, security, aerospace. I know we have a small glitch with the tariffs in aerospace. I read all the headlines. I'm invested in Boeing. I bought it when they were at 133. So I know, painfully aware of what's going on with Boeing, but that company is going to be a monster when we untangle this tariff thing and they get ahead of the 737 MAX thing and some other things. That company, it's a local darling, a lot of jobs, a lot of wealth. Aerospace, going to make a comeback. There's 3 electric plane manufacturers going up in the north end. So aerospace is low Earth orbit satellite companies going up again in the north end. So we have some growth there. Cyber and cloud, not hard to figure out. We've been doing it. We helped invent it. Satya Nadella, the CEO of Microsoft, was the guy that ran the cloud unit for Microsoft. There's a reason he's CEO and a reason he's brilliant. So cloud, cyber, aerospace, and life science is driving the employment. So this number up here is our tailwind. Unemployment is 4.2%. We're the 6th highest in the nation for net job gains for the BLS birth death rate. We got a lot of companies being formed here. So these are powerful. Dr. Jones told me it's all about jobs. I'm seeing we got jobs. So we're going to be able to get through whatever it is. The bull case you see on this side, the bull case is strong. In Seattle, just Seattle, there's 54,200 millionaires. Did y'all know that? I didn't know that until I did this for Charlie and Steve. So, but this is what I really wanted to know. How many here know how many billionaires are just in Seattle? With a B. Anybody know? Nobody cares? Nobody gets the prize? Drawing? 11. 11 billionaires and 54,200 millionaires. Our median income is 123,000. Our median housing value in Seattle is 850,000. Seattle ain't going anywhere. My wife, who's infinitely smarter than I am, when I get down on the Bay Area or Seattle, always tells me, never bet against San Francisco or Seattle. And she's always been right. Because I've been through market cycles and she's always been right. I've been wanting to give up business units. I've been wanting to trim staff and wanting to do all kinds of stuff, but I didn't give up. And I thank my wife for that because it always came back. San Francisco's still dragging a bit, but Seattle, strong. So growth from AI. Right now we have 1,427 some odd jobs. I only know that because I read it right before I got in here to prepare for this presentation. But we have the #2 highest openings in AI in the nation. So while the nation will take a hit in the bear case, on the left side of that diagram is no joke. There is going to be a lot of people wiped out with AI. Law firms at the low level, finance, clerical, admin, copywriting, marketing. I had an inside sales rep call me named Ava. I get sales calls all the time. For where I am at my position at Stewart, there's always somebody pitching me every day, and I always take the sales call because I want to hear these people pitch. I always take the sales call. It's always a data vendor or real estate or this guy or that guy, it doesn't matter. I take the sales call. This one I took about a week ago, and it was Ava. You ever heard of Ava? It wasn't bad. It took me about a minute. And I spotted it. I was like, okay, I was born at night, but not last night. So Ava was AI, but she was not bad. And it took a weird, awkward answer from my third question for me to figure out. I was like, okay. And then I just hung up. Because there's no sanctity in transaction there. There's no social contract when you talk to AI. When we talk, we're either going to make each other laugh or invoke an emotion or teach each other or do something where we connect as humans. And if I know I can't impact you, I'm not going to talk to the AI because humans have social contract. AI is great at automating. If I want to read a title report or do a search, just do this rote, brain dead scanning, and AI can tell me, oh, that legal description's off, or a number of metrics things. But human interaction, it's like, hey, if I said to you right now, there's this great robot laser surgeon, and then there's this dude who everybody raves about in Bellevue. Where are you going to go? You're going to the human, I promise you. There's just certain things that you are not going to do because we're human. And so Ava calls me and I give her like a minute and a half. And after a minute, I'm like, yep, that's interesting. Good job on the intro. And then just cradled her like I cradled any new rookie calling me. So, but it was interesting. So AI, definitely going to take out some of the low end. There's no question about it. Trust me, I'm in that business. I'm watching the waste happening right now. Copywriting out, low end marketing out. But if you want to go high end and upskill, decision making, creativity, those kinds of, how am I doing on time? Okay, almost done. So creativity, there's plenty of jobs. Kinsey says there's going to be a net surplus of jobs in Seattle because of AI. 15% higher. 15% higher. More jobs. More wealth. But my problem is there's a path to get there. And that path involves disruption, pain. What are these 61,000 people going to do? In Seattle, there's 89,360 some odd. You can look it up. Software developers. There's a guy named Kevin Scott. You all know who Kevin Scott is? Kevin Scott is the CTO of Microsoft. This is a quote. It's a quote. I can say it in the camera. Here's a quote. He said, in 5 years, 95% of coding will be done by AI. That's a quote. You can Google it. Everybody's got a supercomputer in their hand right now. Kevin Scott, CTO of Microsoft, says in 5 years, 95% of coding will be done by AI. Now, he didn't say all the coders are going to get laid off. They're going to upskill. They're going to go to problem solving, creativity, maybe making, domain knowledge becomes incredibly important. What you all have in your minds right now is domain knowledge. So somebody has an opportunity in AI is going to be able to take what's in your mind, translate it into an app that's helpful for you. That person is going to survive. The person that was doing rote coding should be looking for a job literally right now. We went from coding to offshoring coding, what was known as global wage arbitrage. Send it to India. You got to come up here? No. Okay, I'm almost done. Global wage arbitrage. So we sent it to India because we had to. There was not enough coders, plus there was cost associated, right? They're pretty good coders for about 15% of the cost. I know, I've seen it. Then we went to low-code platforms. You guys ever heard of low-code? Nobody? Low-code platforms with things like Zoho, Make, Bubble, QuickBase, where you could kind of talk to it, but you had to know some code. Then it went to no-code. That app was kind of crap, but it was like, hey, if you had a simple idea, it could kind of get it out on the web and it would do an app. But there's data sockets and layers that you have to connect to. There's cybersecurity, there's compliance. It just wasn't that great. But then, weeks ago, what lands on us? Cursor. You can look it up. Cursor lands on us, then Windsurf. And I've talked to Sam Altman, actually, and Sam Altman bought Windsurf instead of Cursor. He made it play for Cursor. And Cursor is basically where you speak natural language into this platform, and it doesn't whip out some kind of simple code. It does the data socket layers, it does the cybersecurity, it does the enterprise integration, and by the way, whatever interface you told it to do, it'll build you probably the better one than you could have done because it knows what the best practice interface is out there. Cursor's out there right now. This is changing the employment landscape, but not in Seattle necessarily. McKinsey and the World Economic Forum are saying Seattle is so in the mix that we're going to get a 15% bump. We're going to have those people be the ones that rise up. So that's good for our employment. Seattle patents up 27%. I'll leave you with that. And then our GDP, no slouch. We grow at 3% a year. $700 billion. That is not weakness. That's strength. So we are going to be just fine going through any tumult I talked about. Tech, tariffs, capital shift. We're going to be all right. So that's it. That's the. I'm going to switch over. Actually, if any of you want this white paper, it's fascinating. It's Tactical Keys in an Uncertain Market. Email me. And it talks about capital access and choice. 1892 Capital and people like them play a huge part of that. Strategic asset selection, more important than it's ever been. Relationships and ecosystem. Operational efficiencies, which is a no-brainer. You might be surprised at the tools available to you and your clients, though, for this. And alternative assets and emerging geography. So send me an email. I'll send you the white paper. It's a good read. It's a long read, but it's worth it. And I'm going to leave you with this one slide. Excuse me. This is the distress market. It's like this magic fairy dust. We've been waiting for it. We've been waiting for the dam to break. We've been waiting for all the opportunities. This is it. I'm going to do it in 10 seconds or less. 1.1% of sales last year were distressed. All the sales volume, 1.1% was distressed. That's it. Nationally, 2.5%. That's a fact. Of all the sales, 1.1 in Seattle. All of last year. Nationally, 2.5. That's getting up there a little bit, but still below criticals. So we have $1.8 billion in distressed assets in Seattle sitting right now, with another maybe 5 or 6 in potential. So I'm going to bring up Rob Hurricane Haney to talk about distressed and receivership. He's our associate senior underwriter and the South Sound manager. He's known as a pathfinder and a Jedi. This guy is a gifted problem solver. So if you ever want to talk to an underwriter that is best in class, talk to Rob. He's a great guy. With that, I give you Rob Haney.
Thanks, Warren, and I want to thank Steve and Charlie. You know, the whole team with 1892 Capital Partners, Sid, everybody. I want you to know I've been doing this stuff for a very, very long time, longer than what I want to even tell you guys. But I work with a lot of different types of clients. You know, deals are deals. Sometimes you don't necessarily like the people you're working with. And I just want to say with 1892 Capital, nothing could be further from the truth. They're the greatest people to work with. And I'll just tell you, not only working with them, but getting to know them. And it's been a pleasure to know them on a personal level. I've known Charlie for over 20 years. And again, it's just when you're in this business, in this industry, you don't have to like everybody, but it's nice when you do. And they're great people. I just want you to know that. So I'm going to talk about the distressed market, and this is going to be fast because we want to get Taylor up here. So what I'm going to talk to you, and this isn't the only thing I see coming across my desk, but I see a lot of things coming across my desk, and things have changed, okay? They've changed quite a bit. In 2008, and as you can read up here, you know, and we all know, most of us here were in the market in 2008, and we remember what that was like. It was terrible. You know, the sky was falling in. Residential got hit really hard. Commercial got hit hard. Foreclosures went up. Trustee sales went up. Judicial and non-judicial foreclosures, and as well as a lot of lien foreclosures. So during this period, in fact, I had two deals that came across my desk. One was a $75 million trustee sale, and the other one was a $48 million. By the way, this $75 million trustee sale was bare land. This was bare land, and it was a development project in Pierce County. And that bank took a big hit, but you know what? They took that property back and sold it. The $48 million was a condominium project in downtown Tacoma. So those were just two. So during that time, I saw a lot of different things, but the main thing I saw, again, was just your traditional trustee sales and lien foreclosures. So fast forward to today, okay? So this is, if you would have asked me, and again, a lot of things come across my desk, and I like things that have hair on it. You know, I like, because things can get boring doing what I'm doing, you know, but I enjoy a challenge, and but I will tell you this, the landscaping has changed. If you would have asked me, let's say 15 years ago, well, if you were even asking me 3 years ago, how many receivership sales I've seen, it would be one. There was one that I've seen, that I saw. It was a piece of property in Tacoma off of Mildred Shopping Center. Don't know why it was in receivership. It did. Now, a week does not go by where I do not have somebody calling me up, either opening a new order for a receivership sale or asking me questions about a receivership sale. So why is this the big, where did this come from? You know, how did the landscape change? And I mean, it's been sudden. It's been sudden, and gosh, right now I probably have, I don't know, 15 to 20 orders sitting on my desk. And a lot of these properties, a lot of the orders I have for receivership sales are multi-parcels, they're developments. So we have a lot going on right now. So there's different reasons for receiverships. So for a receivership sale, and what it has that makes it different from a trustee sale is right away you have a receiver coming in and taking over the property. The receiver, he or she is court appointed, and they have a fiduciary duty. So they have a duty to try to get the best market, the best value they can out of this property. And all actions are overseen by the court, and you need to have the sale approved by the court. Now, a lot of people will come to me and they'll say, Rob, I understand you've got this piece of property. It's in, Bellevue, and it's in receivership sale. And boy, I'm looking, this could be a great opportunity. And I tell them, these aren't fire sales. The receiver has a responsibility to get fair market value for the property. So just because you see a receivership sale does not mean that this is, and now it's a little different than a traditional trustee sale or a judicial foreclosure. Any other type of foreclosure, there can be equity to be had in those sales, but receivership sales, they're going to be as close as can be to fair market value, or the court won't approve it. Everybody needs to be made whole who can be made whole, okay? But it doesn't always happen that way, unfortunately. I will tell you one thing real quick. This is really interesting. And again, things that come across my desk, it makes things interesting. So traditionally, what you see at receivership sales is it's the lender who is being made whole. It's the lender who's petitioned the court for a receiver. They want to keep that property viable. They want to keep the rents going. They want to keep the tenants happy, so a receiver is appointed. But I've had the gambit of orders come across my desk. We had a situation where we had a husband and wife were going through divorce, and through that divorce, the wife petitioned for a receiver because the properties were, the husband is a developer, has many properties, he's walking away from it. The wife petitioned the court for a receiver so she wouldn't be brought in to, basically, it wouldn't affect her credit by him just walking away from these properties. So we've also had family disputes. We've had families that cannot decide what to do with properties, and a receiver will be appointed. We had one in Eastern Washington. It was several properties, and there wasn't even any debt on this property. There was no debt. It wasn't upside down. This is people couldn't get along. Family members couldn't make up a decision on who to sell, how much to sell, and easements needed to be granted. This property being gifted to different family members, and when it was gifted, they didn't think about easements, but they thought everybody would get along, right? Well, people don't always get along, even family members. So the receiver came in and created easements, made this property viable, and then sold it through receivership through the court order. If you don't like it, too bad. That's it. You got your chunk, and the deal, it's over. So it's being used to settle disputes. So basically, on the market, the other thing we're seeing too, a lot of deeds in lieu of foreclosure. So we do have owners that are just, you call it throwing the keys to the lender, right? Warren, we're seeing that a lot in San Francisco, a lot of big projects there. And we're seeing it here too, where the owner of the property is just out. And they're not doing this necessarily because they are personally upside down. The project isn't making sense for them anymore. So rather than go through the whole foreclosure process, they're just giving the keys back to the lender, saying, you take it, it's yours, I'm out. Because it doesn't pencil out anymore for whatever reasons. So seeing a lot of that. Again, it's not the only thing I'm seeing, but so Warren went over numbers. I'm not really numbers. I'm in the trenches and I know what I see. So he talks about what the percentages of distressed sales last year. I would have to think by what I'm seeing, that number is going to go up. That number has to go up. I mean, I'm getting calls, a lot of calls. I have a lot of attorney clients, which is great. And this is what they're doing, is working in receivership sales, and there's definitely an uptick. So again, even 2 years ago, we just didn't see this at all. And it has hit hard these last few months. So anyway, I don't want to take up too much more time. You guys know how to get a hold of me, I hope. And if you have more questions on this kind of stuff, it does make life interesting. Oh, we'll stop with the last slide is on bankruptcies. So we do have that as a player. Now, what I'm talking about too is the Puget Sound market right here. I don't know what's going on throughout the entire country, although I am part of the national group and I do get involved with a lot of national deals. But what I'm seeing here in this region is the receivership sales, a little bit of bankruptcies. Basically, too, just want to know receivership laws in the state of Washington pretty much mirror in a lot of ways the bankruptcy laws. So, but I'm not seeing as many bankruptcies unless they're like huge portfolios. I'm seeing some huge portfolios where you've got a owner who has properties throughout different multiple states. Then bankruptcy court will come in then. But anyway, that's mainly what I'm seeing again is the receivership sales. So it's been fun, I'll tell you. This has been an interesting market, and I'm very, very happy to be working for Stewart Title and working with Warren and Jackie. And I actually am optimistic. Even though we're seeing the market and seeing the distressed sales, I still feel there's a lot of really good opportunities in this market. and I'm an optimist. I think there's good things ahead. So that's what I've got. Do you want to introduce Taylor? You want to give him a little bio on Taylor before? Yeah.
Taylor's famous. We don't really give him too much of a bio. It's my honor to introduce.
Thank you, everybody.
Good job, Rob. Good job.
Thank you.
So it's an honor. While he's getting mic'd up, I'll let you know Taylor is founder of one of the most innovative CRE data and AI companies in the Northwest, Navigator CRE. He started in 2015, 2016 after a very successful career at JLL and Colliers. So he knows the investment side of real estate. He knows real estate. And I didn't know this, even though I've known Taylor for a while, and he's going to be a great data partner to Stewart. He's also a kicker for USC. I think that's awesome. Hunter, kicker, and what else?
That's Uncle Pete.
Yep, there you go. So, but this is something that's important because we are at an inflection point in technology and commercial real estate. So we want to bring Taylor on to talk about what's happening. Those that get on board with the team are going to get ahead of it and prosper, and those that are not, I think, will get probably defeated by those that accept it. So with that, Taylor Odegaard.
Cheers. Well, appreciate it. Can everyone hear me okay? Good? All right. I'll get the mic higher. A little bit of my background. Been in commercial real estate, believe it or not, for almost 20 years, plus or minus. Studied real estate finance and development. And my whole career started with frustration in working in internships at some of the biggest institutions in the world. And they all just lived in Excel spreadsheets for everything. Fast forward 20 years. Everyone still lives in Excel spreadsheets for everything. Okay, there's no management of data from a portfolio perspective or a debt or lending perspective that really enables you to use tools and modern day tools. And oftentimes people wonder, well, why are all the banking and fintech industries and healthcare industries, why are they able to make these huge triumphant leaps forward in technology? It's because it comes down to data. There's a quote on the wall of my office that says, data, 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 I cannot make bricks without clay. Sherlock Holmes. And it's a real thing. If you don't put your data together from an organizational perspective or even as an industry perspective, you can't build the house. You can't build anything. So the emergence of really cool things like AI and machine learning that's really come on the scene over the last 2-3 years have actually been around for about 10 years. But the industry itself hasn't had the structure enough to actually leverage some of these tools. Where Navigator emerged as a platform, and I'll take you through it a little bit, really just came out of the frustration and the needs and the painstaking operations that organizations undergo for asset management, property management, occupier services, brokerage services, and logistics. Everyone's passing Excel spreadsheets back and forth. There's no source of truth. There's no source of trend. I bet you if you go in any brokerage house and ask them to, hey, send me the 10 largest multifamily sales comps in Washington State, you will get 5 different Excel spreadsheets with 5 different cap rates and 5 different IRRs and probably 5 different buyers. So that's an issue, okay, if we're going to really use data to move forward. So if you're going to be working in your own enterprise architecture, in your own portfolio, or even as a JV partner or a limited partner in any organization, it has to come down to the data first. The idea is if you understand your own portfolio first, you understand your own assets first, your own debt first, then you can make very, very smart decisions and you will beat the populace. It's a rule. I've seen it. I have over $1 trillion in assets run on my platform from probably 10 of the largest, biggest REITs in the world use our platform because they tried to build something in-house and it didn't work. And once they weaponized their data with Navigator, they started making decisions. You're wondering why some of these REITs are buying assets right now that make no reason why? They're using data. They understand the trend. They understand what's happening. They're able to see opportunities that many people can't see. They're able to stress debt service coverage ratios like no one else can because they understand where the value is at the end of the rainbow. So from an enterprise architecture standpoint, it's really about being competitive and be competitive every day. And he pointed out, I played for Pete Carroll when I was at USC, played in a few national championships, and he came to Seattle and did some fun there. His rule of thumb is compete every day. And you do that in business. It's how I've built my business over the last 10 years, is find a way to be competitive every day with your own organization, within your own organization, as well as with the marketplace. And so there's tools that you can equip yourself with very early on. So first and foremost, understand your portfolio. Where is your data? Where are these blocks of data? Is it sitting in Yardi or MRI or RealPage or wherever it is? Make sure you've got access to it. If you can, that's kind of step 1A. 2, from there, what does your decision-making process look like? What are you using to actually make decisions for an acquisition, for a disposition, for a recap, whatever it might be? Start to empirically enter that information into some place, like a system of record, so you actually can understand why you made that decision, why you decided to take 5 years of IO IO at a really bad interest rate that suddenly is kicking in right now and you can't figure out why you can't cover your principal. That's happening right now. That's a real part of what we're seeing in portfolios. With that, you start to unlock powerful insights. AI and machine learning are very cool tools. You can do a lot of very cool stuff with them. I also have seen a lot of brokers say, write me a lease for 5,000 square feet at this building in the voice of Captain Hook. And it's a real thing. That's how people are using AI right now. And it's kind of funny, and it actually will do it. It'll say, yar matey, yaspi, a 5-year term. I mean, it's real stuff. This is what they're using AI for right now. The idea is if you use it for a better use case, such as, all right, look at my portfolio of my 15 assets in the Seattle marketplace. Based on what I bought them for, my going in cap rate, my expected exit cap rate and hold period, and my current NOI or debt service, whatever it might be, what are my top 3 performing assets and what are my bottom 3 performing assets? And here are my 3 criteria. That's called a simple prompt. If you do that, believe it or not, it'll actually tell you your deepest, darkest secrets about your portfolio that you didn't know, such as you might have a huge maturity or a balloon upcoming. You might have 5 or 6 tenants that you think are locked in that are going away and you didn't realize they're exercising their options. All of these things are in the data, but oftentimes are overlooked when you're only looking at your information once a quarter, once a month, once a fiscal period. So getting more into the weeds of how you use your information is really how you can evolve your own portfolio strategies and ultimately be a better investor and a better lender on both sides of it. Couple things that just kind of highlight points, of some bullets here. So flexible and fast. If you're looking for organizational needs for technology, you don't need to go to the big ERP systems and have them build you out $1 million portfolio management tools. A lot of this stuff can be done very, very light or with great partners and great capital partners that understand the great tools in the industry that can really unlock information and help you manage your portfolio more efficiently, and also use data in a way that helps you be predictive and prescriptive about how you do things. The idea is, for many, many, many hundreds of years, real estate was based around the gut. People made decisions with, I feel like this is a good spot. It's on the right corner, the right lighting from the ocean. That was how most retail was acquired, built, all that kind of stuff. That's now changed. It's got to be a data-driven episode. Retail saw it first, using things like foot traffic and street traffic and cars and things like that. Are people ingressing and coming to the location? Evolution of tools to actually track cell phone track of people going in and out of buildings, of what location they're going to. In our engine, we're absorbing data for some of the largest institutions in the world down to the room level and how many people are in the room at any given time. So I can tell you right now, in the biggest building in Manhattan, how many people are on every floor of that building and for how long during that day. That's how they're making investment decisions around, do we keep this asset right now? Or do we recapitalize this asset? Or are people even coming into the office? And there's stats and metrics that come with the evolution of this. And I'll give you a couple of bullet points. I was in Manhattan last week presenting for a big REIT and on their own portfolio, and I asked the room, what do you think for this big office building, trophy Class A, everyone knows it by name, is the average occupancy, daily occupancy of the tenants in this building? Throw out some numbers. What do you guys think it was? Daily occupancy from 0 to 100%. Throw out a number.
Midtown?
No, Manhattan.
88?
Okay. 88. Anyone else?
42.
Close. 14%.
What?
That's the average daily occupancy in a Class A high-rise in Manhattan. Guess what it is in Seattle? 13%. Not that far off. People don't ever really come into the office 100% capacity every single day. And guess what it was before COVID? About 4% difference. Just now they're tracking it. So as of right now, what's happening is everyone thought that all these buildings were full every single day and all the floors were buzzing every single day. But if you look at the net of everyone in a building throughout the day, it was lots of flow. It's just more evident how many people are working from home or working remotely. But the idea is now you're starting to understand the new baseline. So your building should never actually be at 90% occupancy during a day. That having it between 20 and 25% is pretty solid. That's actually a pretty good rate to go by. And by doing that, that's important. The only difference now is there are a lot less leases in that building. So the difference is you're now seeing less occupancy from an actual economic standpoint. The same amount of people are kind of going in and out that always like to go to the office so that weren't required. Well, sometimes you got to change things up a little bit. I mean, Alex and I were just talking about one of the last deals I did with his partner. We sold an office building for $1,000 a foot, not too far away from here. Now they're trading for $200 a foot. So higher, better use, all of that kind of stuff goes out the window. So now it's data-driven decision making. How can you recapitalize the asset? How can you change the tenancy mix? How can you go from single tenant to multi-tenant? All of these things start to come into play, but you can use a lot of data to make a lot of really cool decisions. But this is the example of the information that a lot of big REITs are looking at right now, is they're getting into the weeds. I mean, getting down to the roots of the tree of like what's working, what's not working, and do we continue to own this way? So last two elements I'll give you. AI is a big thing. Talked about it. Warren's obviously a pro at this stuff. We have our own engine and navigator called Navi AI. We've been building it for 3 years. It takes a lot of time to train something to do something. I have 2 4-year-olds. Native AI, it has about the intelligence of a 4-year-old with regards to answering questions. It's very stubborn. It doesn't know things. But once you train it, it becomes Einstein. So when you train an AI engine with what it should know how to do and how it should answer and the pros and the prompting, you can actually start to ask questions. So one of the things we've been deploying for a lot of clients is they can literally just ask, tell me about my portfolio and write me an investment summary on this asset as if I was going to sell it for a 5 cap today. And there it goes. It'll write you an entire investment summary in less than 3 seconds. Something that I used to do as a professional that would take me a week. Alex knows this, he does it still. So the idea is using technology like this where you've breathed into the technology, you've given it the intelligence, you've given it the understanding of what you want the result and the outcome to be, but you let the data drive everything around it. That's where pure innovation starts to occur. That's where real estate will actually start to be able to use data in an effective and effectual way. So, time, are we good? Okay. So a couple of things that I want to cover just for you, so you're aware. There's been some evolutions regarding data and AI and commercial real estate over the last 5 years, if you will. Instant valuations and predictions. Now, here's the one thing, the caveat I'll give you. These things are really cool. But if you're a lender, would you just commit a whole $100 million loan because AI said you should? The validation is the next step. The curation of these responses, the curation of the data so that you can actually trust it, make a decision with it, and trust it wholeheartely. Right now, the underwriting process for a Class A office building, might take 6 months. You're not going to let an AI engine in 60 seconds say, yeah, you're good, here's all the metrics, we're good to go, lock it in, let's rock. The process has to be brought into that. So that's where people are really important. Processes are really important. You can decide within your organization how you want to implement different tools for machine learning, AI, and personal touch to make sure the decisions at the end of the rainbow are risk averse, making the right decisions. You're not putting equity at risk. You're making sure you're making good acquisitions opportunities. You're also making disposition opportunities, saying, hey, we might not want to hang on to this anymore. This might not be our cake anymore. One of the biggest things I've noticed in my business with a lot of our large clients is the fact of for many, many, many years, debt was very cheap, very easy to get capital, very easy to buy things with pretty high LTVs. What we're noticing now more and more, especially as a lot of these large loans along large portfolios, we're starting to literally meld live, real-time, daily NOI against debt service coverage ratios and debt yields, and actually looking at them in real time. And it's surprising how often you're actually looking at this data and realizing how close over the last 10 years you came to your actual covenant yields. A lot of these companies starting to realize, wow, we had covenants that we had to hit, and we got pretty dang close during COVID, and maybe even after COVID. And now that our principal and interest rates are starting to bump up a little bit, it's getting a little hot in here. And they're trying to figure out where to go with this. And so this is a great opportunity for lenders to re-engage with their owner-operators and really help them understand, hey, there's relief here, there's ways to restructure deals. Transparency is important, making sure that they know and you know what's going on. But playing the game of plausible deniability will hurt everybody. So the idea is use this data to make really, really smart decisions, being able to look at an entire amortization schedule or a debt schedule, look ahead of time and say, hey, we're going to be able to hit this balloon payment, let the bank know way ahead of time if we're not going to be able to do it. Otherwise, you can end up losing that asset to receivership, and which is where Hurricane likes to play. So the last thing I would say is the idea of using data within your portfolio. It's about return on investment. The idea is as much as you put into it is as much as you'll get out of it. So you've got to want to do it. You've got to want to use your information. You've got to want to leverage capital partners, leverage data sources, leverage professionals in the business on both the lending, brokerage, capital markets, title side of things to make really good decisions and smart decisions. They have a ton of data to work with, which is fun. So don't feel like you're starting at level 0. Chances are you can stand on their shoulders and be at the 10-yard line from the day you start. Being able to use that data to make really good decisions and let your advisors really breathe into that decision process. And last thing, little plug for my company, like the idea is we do all this. That's why we built our engine. 99% of our platform has been designed by our customers. And those customers are name brands and name brand REITs, and they've all said, if you could do this, you'll change your life. And so the art of the possible is our brand. So thank you guys for your time today.
Well, I got the easy or hard part. One thing I find really interesting about, I would say, my success, which came later in life, what I've come to understand is it's really about people. So who I'm following are very intelligent people, and I highly recommend when you network, that's the best thing you can take away. Even if it's one relationship, somebody that's much smarter than you that can help you spot opportunity or spot changes in the market that will make your success apparent. It's good to have. I think our success also on our capital side is our focus. For those who don't know us, I'm Charles Farnsworth. I'm the fund director for 1892 Capital Partners. We've sort of adapted to this constant changing landscape in that we don't underwrite in any specific way. We do have specific collateral requirements like most lenders, but where most lenders may have covenants that they perceive risk, we can generally underwrite around it. What I found really interesting about these speakers is that I struggle with AI. I think I used to be the younger kid in the crowd. Now I'm sort of the older guy in the crowd. And I've prided myself in my career as being in a domain for so long that I have a good sense of what people refer to as intuition. And that is becoming a challenging skill. With AI and what it can do, it can help solve those intuition issues. So I've learned that what I've had to do is change as well. And part of that change is I have to learn to use all those skill sets that I used intuitively to learn to prompt AI to ask it to do things that I want to do. I have to change my entire way of thinking and things that I thought I knew. And so when I'm hearing a lot of the presentation today, my biggest issue that I struggle with is how do I use AI on a daily basis? I mean, our family office is growing quickly. We're constantly challenging ourselves with what is the best way for us? How do we utilize it? I was laughing at the spreadsheet analogy because I'm working on a process for part of our loan program, and I'm effectively using spreadsheets the whole way around. But ultimately, we'll take that data and we'll try to find a way and a smarter way to use it. So I hope, if anything, that people take away from this meeting is AI is here, technology is here, and a business that has been, at least real estate that's been very people to people, is changing. There are aspects of our business that aren't going to change. There is a very real component in what we do. And so networking, getting to know people, bonding with people, solving problems with people is something that I think AI is going to take a long time to overcome. For example, we make loans, and with loans, they don't always perform perfectly, and we have to work with people. I have to anticipate what somebody's going to do, and that's not based on data. It's emotionally driven. What's important to them? How are they going to respond to the stress? Do they have families in their lives? Is their families coming first? Do they have integrity? All these different things are extremely important, but at the same time, technology is going to change the way we make decisions. But people still have to help manage people. So I hope, if anything, you've been able to make a connection with somebody here, somebody that's knows more than you about something, smarter than you, or can maybe provide an opportunity. I appreciate you all for coming out. We'll probably have more of these in the future. Please drive safely and have a wonderful weekend, and we look forward to seeing you soon.